So hello, everyone, from wherever you're zooming in from. My name is Megan Wilden. It's my honor and delight to be the director of OLLI, the Osher Lifelong Learning Institute at Berkshire Community College. We are a lifelong learning program that provides over 150 learning opportunities every year, designed especially by and for people 50 years and better. This fall, our classes start next week. We offer both online and in-person classes. We also have a distinguished speaker series, special events, shared interest groups, and we have OLLI members that come together to create really exciting programming, and that's what you're experiencing today. This is presented by the Tech Impact Forum, which was begun by 4 intrepid OLLI members who really wanted to explore the future of technology. Jim is one of them, and he'll be telling you more about that. So I'm going to hand it over to James Rosenstein. He is a former vice president for external affairs at Toyota Motor Europe, global director, external affairs at Bentley Motors. I hope you got a souvenir from that one. And a former executive director at the Brazilian American Chamber of Commerce in New York. And he will be introducing our speakers as well as our moderator today. So welcome and enjoy.
Thank you very much, Megan. We are delighted to welcome you to the Tech Impact Forum. It's an OLLI initiative in partnership with the Berkshire Innovation Center and One Berkshire. As we know, new technologies are having a major impact on the nature of work, markets, education, training, economic development, and more. We are committed to advancing regional understanding of the nature and potential of current and emerging technologies and how best to take advantage of them while enhancing equity in the Berkshires. And we're happy to provide more information. Now, cryptocurrency, a digital currency that has been developing for over 10 years, has attracted intense and accelerating interest across the world. It has also sparked controversy at different levels, with much to be clarified. Our 2 speakers, whom I will introduce in a moment, have deep experience in the field, will explain the fundamentals of the system based on blockchain, and will highlight the many implications of its growth and potential. Now, Paul Farella is the managing director at Willow, an independent registered investment advisory firm located in Pittsfield, Massachusetts. He works closely with the firm's founder, Alexandra Dest, who is sitting there right next to him, to manage over 140 million in client assets. Willow is a B Corp, a benefit corporation, and certified women's business enterprise, which prioritizes ESG, which is environmental, social, and governance factors, into the portfolio creation process. Paul holds an MBA with a focus on sustainability from Antioch University, New England. He earned a BSBA in economics and finance from the Barney School of Business at the University of Hartford. He's a member of the Stakeholder Council for the Global Reporting Initiative, GRI, an international NGO that helps businesses, governments, and other organizations understand and communicate their impacts on issues such as climate change, human rights, and corruption. Paul is also a member of the Digital Asset Council of Financial Professionals. Now, Lewis Cohen is the co-founder of DLx Law, a law firm created to serve the needs of a new technology-driven economy. Lewis works together with co-founder Angela Angelovska-Wilson and the rest of the DLx Law team to provide in-depth legal counsel to startups, growth companies, major enterprises, and governmental entities on a broad range of matters involving the use of blockchain, cryptocurrencies, and other disruptive technologies. Passionate about the ability of innovative technologies to change the way businesses and individuals work together, Lewis has become a major advocate for the potential of emerging technologies to benefit and transform industries around the globe. Lewis brings more than 20 years of experience as a traditional capital markets and finance partner at 2 global top 50 law firms. He is a frequent public speaker on the topic of blockchain and distributed ledger technology, and has served on the board and executive committee of the Structured Finance Industry Group, SFIG. Lewis is also recognized by Chambers Global as one of the only 3 lawyers in Band 1 for legal for blockchain and currencies USA. Now, we very much look forward to your questions, and please bear in mind that the main purpose of the event is educational and to clarify many issues, but specific advice cannot be provided. So let's dive in. First question for Paul. Very straightforward, simple question. What is cryptocurrency? And that should include blockchain, how it works, like people talk about mining, whatever that means, putting currencies on the network, how it's used as a currency, transactions, this thing called disintermediate finance. Is it the new gold? And how do we assess its real value? So Paul, please take over.
Yeah, sure. So being in a regulated industry before I can really dive into it, just need to do a quick disclaimer.
Yeah, that's why I'm here, because I'm here to give the disclaimer. So the information Paul will be discussing is for educational and informational purposes only and should not be construed as investment advice. The information discussed is not an offer to buy, solicit, or sell any securities. It should not be construed as an offer to sell any investment product or service. While the information presented is believed to be from reliable sources, we cannot guarantee the accuracy or completeness of the information.
Thank you.
It's up to him from here.
Thank you.
Yeah.
All right, so what is cryptocurrency, right? This whole idea of around cryptocurrency, distributed ledger technology, blockchains. I'm sure we've all heard all of these different terms and are probably extremely confused on what is all of this stuff, right? So at its base, the best way to think about it is a blockchain is a ledger, right? A ledger system. And what is a ledger? It's just a record to keep track of who owns what or what is where, right? So you can take this idea of a distributed ledger and then say, okay, we put it online, and then instead of having it reside with a centralized entity like a bank or a company that keeps their own internal ledger, it is distributed around the world so that there are multiple people or parties that all work together to verify the data that is on that ledger. And that is what is called mining, right? That is the different types of algorithms that are used to, blanking on the term right now. Lewis, help me out.
Validate?
Yeah. Right, so we have this distributed ledger system, right? It's just a distributed ledger. It just means it's spread all around. A blockchain is this way to take that data and make it so that all these different transactions on the ledger are put into a block and then verified through different consensus mechanisms, which is what mining is a way to get consensus on the blockchain. And then it is spread around all the world so that there's no one entity that can sort of take over or stop somebody or censor different types of transactions. So hope that makes sense, James.
That's a very good start. And we now go on to the next question for Lewis. How, why, when, and by whom was it created? You hear this name, Satoshi Nakamoto, but is it real? And some people are saying that it was a response to the financial crisis in 2009. Banks are not trusted anymore. How, please help us understand.
Sure. So long before this technology in its current incarnation was developed, there was a relatively small, tight-knit community of people who, in the earliest days of the internet, who shared a common vision of independence and privacy and the importance of kind of individual rights. And broadly speaking, they refer to themselves as cipher, with a PH there, cypherpunks. And the cipher is because one of their common interests was in cryptography and the ability to use cryptography to promote privacy and individual rights, et cetera. And out of that community, there were messaging boards and messaging areas where a number of people participated. Some of them used their own identities, others used anonymous identities for, again, a desire to keep private. One of those is either an individual or possibly a group of individuals who used the moniker Satoshi Nakamoto. I think the only thing we can say with any reasonable confidence is whoever he or they or she are, they're not named Satoshi Nakamoto. So that account, that individual or group participated in these forums, and a lot of people contributed different ideas. I think for anyone who is at all interested in this topic, and I'm sure, Paul, you would agree with this, I would highly, highly recommend reading the Bitcoin white paper. It's all of about 6 pages long. It has a little bit of math. I'm not a mathematician, trust me. You can make your way through it. I often tell people that if you just start on page 1 and every time you don't understand something, look it up and keep going. By the time you get to end of page 6, you'll know everything there is to know. It's a great framework for understanding. And the Satoshi account basically had been fooling around with this idea, both the conceptual ideas as well as the actual underlying coding, building upon developments from a number of other computer scientists and cryptographers, and published the paper in late 2008. And the first, which was indeed as the financial crisis was just getting going, and I believe the first transaction was early, I think January 2009, somewhere in that ballpark, and famously included a little bit of metadata, which was the headline of the London Times or one of the major London papers at the time about the financial crisis, and so is associated with it. And for the person asking, where do you get it? If you just Google Bitcoin white paper, it'll come right up. It'll hit you on the head pretty quickly. So that was basically the birth. So Bitcoin is the first operational example of what we now generally call blockchain technology. The term blockchain as one word is not actually used in the Satoshi white paper. He refers to block with a space and chain, but that gave birth to the concept, and of course has been expanded upon, as we'll talk about in due course.
Very good, thank you. Now, coming back to Paul, it would be good to understand, now that it exists everywhere, what are its uses and purposes? For example, currency, transfer of value, transactions, non-fungible tokens, if you could kindly talk about that, which is very confusing. Also moving into traditional banking services, such as lending and borrowing, and what are the differences between crypto and banking services? For example, Paul.
Yeah, so at its base, anything you can use or anything that uses a ledger currently to keep track of who owns what or what is where, technically a blockchain could theoretically replace or be used in that same case. Some of the major developments that are happening in this space too are, instead of just a blockchain being a place where Alice sends 1 unit to Bob and that is recorded and okay, that's the transaction, you can now start to add things like code on top of that. So you can almost have a programmable language that is built onto that, effectively creating what is called smart contracts. So the computational power and what's able to be done on these platforms is ever expanding currently. Sort of the low-hanging fruit, or the things that we're seeing picked first, are this idea of currency, right? Where it's very simple to send a unit back and forth from one person to the next. But we can make these more and more complex transactions to the point where entire derivatives of this or that or the other thing can be built on top of these platforms too. So we can make the use case exponentially more complex over time. So it allows it to really step into all these different facets of business, finance, economy, law, supply chain logistics, energy markets, all these different things. Blockchains can have a use in. So when we're talking about things like NFTs, those are essentially non-fungible tokens. The way to really think about it, and I think a way that might really make sense is 50, not even 50 years ago, 20 years ago, baseball cards, or trading cards were really big. And if someone had a really rare or a really, good player, right, there were only a certain amount of those cards that were ever made. And so that is essentially a non-fungible trading card, right? Because it has unique properties that are only represented on that thing. If you take that concept and idea around trading cards and unique attributes to a limited supply of assets, and you were to move it from, I guess, the analog world and into the digital world, that really is where this idea of non-fungible tokens and NFTs really steps up. Because now you have, instead of a physical representation, it's just a digital representation, which a younger generation, being digitally native and much more used to doing things online, it makes sense that they would flock to those kinds of assets or those kinds of things on the internet, as opposed to like a physical trading card. And that's where different generations might put value on different things. That's just one of the potential use cases of NFTs. You can do numerous more things, and I don't want to get too far into the weeds around them, but things like fraud prevention, because of the uniqueness of a non-fungible token, you can do things like fraud prevention, authenticated things like concert tickets. You could tokenize art, music royalties. All these different things can fall into that category and will most likely be disrupted over the coming years by this technology. What we're seeing now is really the beginning of it. And yes, there are people who you might have heard some stories, spending tens of millions of dollars on an online image or a JPEG or something. And that's just, I think, indicative of people who have made a lot of money in this space, really just trying to play with things and try things out. But where this ultimately can go is what's really exciting around this whole idea of NFTs. So you mentioned a few other things, Jim. Did you?
I mean, but before we go on, one more thing about NFTs. How is it that they have reached such unbelievable levels of value? It's just a picture. Why are people willing to put so much money in an online picture?
Yeah, a lot of it is just around hype or excitement. I mean, you have a community of people who got into this technology extremely early, made extreme amounts of money, and maybe they don't want to cash out and they want to keep using the infrastructure and proving the use cases out, and they're able to send vast amounts of digital wealth for things that most people would probably describe as silly. But
yeah. The other question had to do with, moving into traditional banking services, lending and borrowing. And so if you're comparing crypto and banking services, what are the big differences?
Yeah, so the idea of smart contracts allows many of the different banking services like lending, yield generation, all these different ideas to, instead of relying on a bank or different people to perform those functions, you can actually have it coded into the smart contract itself. So you're not trusting someone, you're actually trusting code or math, right? So instead of trusting an individual, you're trusting math in this case. People are able to then take these different protocols that have been built that live on these blockchains, and then have them interact with each other in certain ways to execute to meet those kinds of needs.
Yeah. Okay.
So how does that, what does that ultimately mean is that where we sort of see this all going is that you'll have these at least innovative banks and institutions that are, fintech companies that are trying to stay relevant will most likely be adopting a lot of this stuff on the back end so that their infrastructure runs off of it, but they still have a nice friendly face where you can still interact one-on-one with somebody.
Yeah. Okay. Now, Lewis, little question, what is its potential? And to add to that, what are the risks? I mean, everybody sees that it's very volatile. There's no FDIC consumer protection. The yields get so high and then they go way down. And then there's this other point which is made by a number of people. Does crypto foster financial inclusion? And here we have one country, El Salvador, that's actually decided to adopt it. So I'd appreciate your comments about all this.
Sure. Again, I'm sure, Paul, you and I could spend the rest of the afternoon just talking about that question alone. James, is an excellent question. Just a few high-level remarks. When Bitcoin itself was developed, and I put a link, as hopefully most folks saw, to the white paper in the chat. So please look there and click on that and get. But when Bitcoin was developed, the title of the paper is a peer-to-peer system for electronic cash, or whatever exactly it says there. Bitcoin was not meant or designed initially as a store of value. It was designed as a means for people to pay other people at a distance over the internet without an intermediary. There are a wide variety of reasons why that did not pan out, or at least has not panned out as of yet. And that's a separate conversation I'd park for the moment. But the net result is there's not Bitcoin and other cryptocurrencies have not actually been widely adopted as a payment tool in the real economy. They're widely used in the digital sort of online crypto economy, but that's separate. In the real economy, when you're buying a cup of coffee, when you're doing all the sorts of things that you do, from a home down to a cup of coffee, you're not paying it Bitcoin or any other type of cryptocurrency. Instead, what people focused on was using Bitcoin in particular and other digital assets as stores of value. That is to say, because, as Paul explained a moment ago, of the certainty you can have over the finite number, their exact locations, the addresses at which they're held, et cetera, you can have a lot of confidence, even more so than with physical gold or other items, that you know exactly at any given point in time what percentage of the total network you might own if you decide to own Bitcoin or other digital assets. And that that has encouraged people to think of Bitcoin and other cryptocurrencies not so much as a payment tool with a stable value, but actually something that is expected and anticipated to appreciate in value as more and more people think of it as a store of value. But because there is this extrinsic network effect of how many people at any given time are interested in owning Bitcoin or other digital assets, the value of the asset could be subject to the vicissitudes of the market, as other commodities might, with silver, gold, other things. What are they worth? Well, how much is somebody willing to pay for it at this moment in time, in that value, in that amount, in that quantity, I should say, and at that place? That's what it's worth. It's not worth anything more or less than that. And because we have tremendous uncertainty about what someone or how someone might value a given digital asset at a point in the future, we also have very disparate views among potential purchasers as to what that value is. Somebody might, and I sort of am often amused when people try and get unduly precise about, well, we think, Bitcoin is overpriced at $30,000 a unit or underpriced at $50,000 a unit. Well, you got a view, you go with it, right? Because the future will inform you. With other digital assets, it's even more speculative. And there's no question that speculation is there. I think, and there was our SEC chair, Gary Gensler, spoke to the Senate Banking Committee earlier today and covered, among other topics at some depth, his views on cryptocurrency, and perhaps we'll have a chance to speak about that later. Chair Gensler is a very informed guy, incredibly smart guy, but he's referred to digital assets as speculative assets, as if that were sort of some kind of negative moniker, like, well, why would you ever want to own a speculative asset? Well, many assets are speculative in value. That is to say, there's not a consensus around what the value of that asset is. That's an opportunity. Of course, it's a risk. But the only way you have opportunity is when you have risk. You might be right, you might be wrong. And I'll just leave you with this last thought so we can go back to Paul. But one way I sometimes analogize looking at all these different cryptocurrencies and other digital assets is imagine that we're building out the rail networks in the West back in the 1800s. But instead of having one network with a lot of traffic on it, we have multiple networks that are incompatible. A simple way of thinking about their incompatibility is they're of a different gauge, right? If they're of a different gauge of the rails, you're not putting the traffic from one onto the other. They just, they're doing their own things. They may be near each other, they may be far from each other, but they're all these different networks. Some of them just don't do anything at all. They go in a circle and like, wow, what's that about? Fair enough. People are speculating on which of these networks will attract the most traffic in the future. People say, you know what, the way that one is designed, it goes from here to there. I think those are important places. It has these characteristics. It allows trains to go faster or whatever, characteristics may be of value. And they're saying, I want to own some of that. But rather than owning the shares in a company that operates that rail network, you get to own some of the rails, the physical rails. Okay, I've got this mile of track, that's mine. That's like owning this Bitcoin or this Ether or this Solana, et cetera. You own a little piece of that network by owning those digital assets. And whether one is worth more than the other, who the heck knows? We'll find out. How much traffic is Solana going to have versus Ethereum? There are those who think it's going to really be a tremendous amount and will become much more valuable in the future. It's speculative, it's uncertain. We can evaluate the different networks and make informed judgments about which we think will have greater value in the future. But, folks like Paul, that's what they do for a living. I just, I'm impressed.
Yeah. Yeah, and I presume it depends also on what people do. I mean, the whole case of Elon Musk, who bought $1.5 billion worth of it, that really affected the value, right?
I would say that affected the price.
The price, okay. Then I asked the last question about this whole thing about financial inclusion and countries like El Salvador getting more opportunities. What do you think about that?
I am personally really skeptical about that. I don't believe that's a good argument for crypto or digital assets, at least at this point in time, and at least vis-a-vis developed nations. I think there are edge cases, and I don't even know that I would put El Salvador into the edge case, but I think there are some edge cases. What people complain about around inclusion is, banking the unbanked. You'll hear that term very often. Well, folks are unbanked, not because banking is not possible, but because there are some impediments. Very often documentation is a major impediment to being banked. You have to go into a bank and produce documentation. If you're someone who is not here legally, it can be very difficult to get banking services. That's totally fair. Crypto doesn't really solve that. It just sort of works around the rules that are problematic. And I think that's not a long-term value proposition. That's just saying, well, if we ignore the rules, we can do well. So if, fill in the name of your favorite neighborhood bank, if they didn't have to check anybody's documentation, they could bank people all day long. So most of the financial services that are provided on crypto networks, digital asset networks, are kind of like prepaid phone cards. So prepaid phone cards are how quite a lot of the less advantaged get their phone service because they pay in advance. And that's how crypto works. People secure first, they have some amount of capital, and then they do other things with it. In the same way, you can get phone service if you pay in advance. And if you don't have to check anybody's documentation, sure, you can have a phone. You give me a $100 bill, I'll give you a phone and 10 hours of talk time. That's basically what we're doing. But in the world of finance, that doesn't really fly from a regulatory matter. So I don't know that crypto is a great solution for banking the unbanked, at least as far as I'm concerned, but I'm happy to debate folks on that topic.
Sure. Okay, Paul, do you think that cryptocurrencies can compete with existing currencies? And partly linked to that, what are its impacts on banks and the finance industry?
Sure. So absolutely. Could cryptocurrencies compete with existing currencies? Yes. Maybe not in the way that you'd initially think, where something like, for example, Bitcoin's going to come and then replace the US dollar, at least not in the short to medium term anyways. But that said, what we do see happening is all sorts of different countries starting to adopt central bank-backed digital currencies or other forms of digitizing their payment. And I think we'll speak a little later about the digital yuan as an example. But why could it compete is very, very simple. And it is that as a species, the medium of exchange that we've always used to trade or value our time has always changed. And it always moves in the direction of whatever is most convenient and practical and easiest to use. From things like rocks to gold, rocks to salt to gold, to paper to plastic to numbers on a computer screen. Most banking is done electronically these days. So now, why not? Couldn't it be something that is hosted on a blockchain, but that we transact through mobile phones or whatever else? So absolutely, it could definitely. This whole technology could ultimately end up replacing currency. Just as the new medium that we use to transact, because it's easier, or it could be easier down the road, assuming development continues at the pace that it is.
Interesting. Okay, now there are so many articles about cryptocurrency, and one of my questions is, why is there so much talk about it? And a few things that come up all the time: the challenges. For example, government control and regulation. Could that undermine cryptocurrencies? What is it going to do? Do governments want to create their own? To what extent do they want to regulate? And there's another one, which is the environmental issues. I read this all the time about mining cryptocurrency spends more energy than a whole country. I forget which one, but is it true that it's going to destroy more of the environment because of the amount of energy that it consumes, and so on and so forth? And then there's the other thing about fraudulent usage. There was this, the Colonial Pipeline, and there are other cases, and people are saying, be very careful because it's easy to use fraudulently. All these questions come up, and there's nonstop talk about it. So Lewis, what do you say?
Gosh, you got, like I said, so many good questions in the chat. As I said, I love it. I'm just trying to think where do you start here? Well, it's a little bit like the magazine articles. I'll start there. It says the saying goes, everybody talks about the weather and nobody ever does anything about it. And it's a little like crypto. Once you fall into, so many people refer to it as the rabbit hole, using the Alice in Wonderland analogy, and it's very true. Once you start reading up on it, you become very, very engaged. Many folks do, and want to write about it, want to explain it to your friends until they make you leave the house. You really get very, very engaged with it, and so I think that's just part of it's a fascinating area. In terms of, let's talk about, I guess I'm going to pick out two things, and then we'll come back around and Paul can pick up some things. I'm going to talk about energy usage, which is always a subject, which ties briefly back into a subject, Paul, you explained a little earlier, which is mining. So we'll talk about a little bit of energy usage and then illicit usage, and I'll touch on just those two things very quickly. It's important to understand that the process, if you're going to have a independent distributed ledger that's not controlled by anyone, you need a process by which everyone agrees on what the state of that ledger is. So ledgers like cogs in a gear move in a ka-chunk, ka-chunk, ka-chunk kind of methodology. It has a state like this, person one has this many, person two has that many, etc. And then there's a passage of time and that state changes. And now person one has that many and person two has this many, etc., etc., etc. What becomes critical is agreeing what the next and correct state of that ledger is, right? So that's the whole sort of enchilada here. And that actually combines technology, which is really not a complicated technology, and game theory. And the game theory and the economics are why this process consumes so much energy. The protocol or set of rules, which is all the word protocol means, the protocol for creating a new block or new state of the Bitcoin ledger fundamentally just turns on one thing: having everyone agree what the last preceding valid block was. And everybody looks at the last block and then seeks to create a new block. And by block, I just mean a set of valid transactions. But kind of how do you make that process? What stops someone from just saying, I think the next block is this or that or the other thing? What stops that is what's known as the proof of work, consensus effort, or consensus, proof of work, let's just leave it there. Proof of work, which involves everyone who competes in order to validate transactions, and they compete by expending energy. And that how that energy gets expended is frankly irrelevant for our purposes. But they expend energy. And so by expending energy, the blockchain can be viewed as a record of the expenditure of energy. And because the latest block involves the most expenditure of energy, to create a different record or a different order or a different state of the ledger, someone else who wanted to attack the ledger or disrupt it or compete with it would have to expend more energy than everybody else taken together. In fact, approximately 51% of the total amount of the energy. And that's so costly that it becomes very difficult. So the energy usage is what actually protects the network, and at least in the case of Bitcoin. And so, as often said, the use of energy in Bitcoin is a feature, not a bug. It's a necessary element that it's costly to validate transactions that makes it very difficult for an attacker to disrupt that ledger. Paul, I'm sure have some thoughts on that.
Yeah, it's essentially the price of security. I mean, one of the ways to think about it is, and there's a lot of different articles out there that I don't think do the best job really explaining, or the comparisons they use with, the Bitcoin or proof of work consensus mechanism itself uses X amount of energy, and then what are they comparing it to? Ultimately, one way to conceptualize it is that these, in a way, are borderless digital nations, right? And to use that energy is the security that keeps that nation safe, so that when people move real dollars or their real value onto those networks and then transact with somebody, they want to make sure that they have this insanely high level of security. And so there's a high energy cost to create that. It's a feature, as you were saying, not necessarily a bug. Now there are developments happening. There's this whole idea of proof of stake, which would lower the energy cost by 99% or something like that. But it's still in its early phases, I guess, still to be developed. But it's also another consensus mechanism that might directly address a lot of these environmental issues that are presented in the proof of stake. Is just a different consensus mechanism than proof of work. And we don't need to get into the details too much, unless Jim, you want us to, but it's just.
Yeah. However, you did say to me at one point that a lot of the energy comes from renewable energy. What is the exact percentage of renewable energy that's used for all these transactions?
Yeah, so it's really hard to tell, but there was a report. I think Deloitte or a few other large accounting firms, some big companies did, and they found something like 75% of all the electricity used in the proof of work mining operations came from renewable sources. Most of that came from hydroelectric dams. A lot of that was actually in China. There's a lot of it in Iceland with geothermal. But there's been a big crackdown over the past year in China. So I'm sure those numbers have changed over the past several months. But there is a report out there by some very reputable companies that put the number around 75%.
Right.
Making
Lewis,
it actually one of the greenest industries in the world.
Really? Oh. And Lewis, did you have any further comments, or is that
well, I was going to just round out on the illicit use of digital assets, and
yeah,
there's two sides of that. The first is, yes, of course they're used for illicit purposes. Nobody's disputes that, but last time I checked, prior to 2009, there was quite a lot of illicit activity, and this is not a new concept. Like, we discovered digital assets, and now people are laundering money and doing crimes and doing a wide variety of things. Unfortunately, it's a feature, not a bug, of human nature that people will tend to do illicit things, and they will use whatever means is at their disposal to do those things. Prior to the advent of digital currencies, they find plenty of ways to launder money and commit scams and frauds and all sorts of shenanigans, and they will continue to do that. And if we have a next state after digital currencies, people will use that too. I think it's a mistake, in I think my view and most proponents of blockchain technology and digital assets, to sort of assume that because we can identify cases like the pipeline ransomware attack, where digital assets are used, that somehow imputes negatively onto the digital asset. In fact, as many people have pointed out, the culprits in the pipeline attack were identified within, I think, a week or two of the attack, and the money and the value of the Bitcoin was recovered. Because, actually, a blockchain is a very poor way to do illicit activities because it can be tracked very easily. And you get into complex areas about the things that are used to wash Bitcoins and mixers and all sorts of things and privacy coins. But the bottom line is it's not super effective. So I really think that the scare tactics you hear about, oh, but people are using Bitcoin or other digital assets for illicit purposes, should be almost completely disregarded. We should, of course, our law enforcement, officials should take active stance against people who use digital currencies inappropriately or illegally, as they should people who use regular money, illegally. So that's I guess, I don't know, Paul, if you want to add anything.
Yeah, right. Just to your point, these are public ledgers, so they are transparent by nature. So it's not the safest place to be committing crimes on. Second, too, right? Do you blame the blockchain for? There's always going to be bad actors out there, right? Using whatever tools they can at their disposal. If a criminal uses the U.S. dollar to commit fraud or something, are we going to blame the U.S. dollar system and say that is sketchy or scary? Only criminals use it, things like that. I think too, there's some statistics on the FBI website or something that looks at, how much fraud happens every year, and something like 1% or less is committed on blockchains.
Yeah, yeah.
Compared to all the other currency, regular U.S. dollar, and arguably the U.S. dollar facilitates the most crime in the world. But what do you?
Yes. Okay, the next question goes to you, Paul. Will governments create their own cryptocurrencies? I mean, we have with this one case of El Salvador, and everybody's talking about the influence and impact of China. Where do you see that going?
Yeah, so will governments create cryptocurrencies or move to digital currencies? I think we're going to get a mixed bag. You have countries like China who are taking a really authoritarian top-down approach. They started working on their digital yuan back in 2015, maybe even earlier than that, and have been developing it ever since. So that is the direction they are going. One of the main reasons that they would want to do this is so that they can transact with different Belt and Road Initiative countries to essentially bypass the need to buy US dollars or use US infrastructure in order to facilitate purchases and commerce with those different Belt and Road Initiative countries. So it's something that, the US, we really should be paying attention to this. It's something that when you look more at how Western countries are sort of approaching it, it's more let private industry figure it out, right? And then ideally bring in the right regulations to make sure that it works for everybody.
Right.
So I don't see, the U.S. Federal Reserve minting a digital asset anytime soon, but I could see U.S. private sector industries, which arguably there already are a couple companies out there doing this, that basically are backing their digital dollar with dollars custodied or held somewhere very securely, and it's audited frequently so that they actually can say, okay, this $1 for my, on this blockchain is physically backed by a real dollar somewhere else that's, custodied at a bank or something.
Yeah.
So I think that's the direction that will go. As an authoritarian country, or maybe a bad actor or a government that really wants power, it would make a lot of sense to do this because of the amount of transparency inherent in blockchains. You get a line of sight into how every dollar in your economy or your citizens moves. And then if you're the Federal Reserve or whoever, and you make an account for everybody, and then you're putting all the currency on that, you can see how everybody uses the currency. You can freeze people out, you can lock people. So I mean, from an authoritarian's view, it's a fantastic tool to keep control and really
Right.
keep control over your population. Yeah.
Right. And China might just do that, right?
Yes, it looks like they're already doing that. Actually,
Yeah.
they've been rolling this out, their digital yuan, in several different cities with millions of people in them. I was reading something about how the way that they've approached this really allows for almost anybody to access their system. So you don't even need internet, really. If you, I mean, at some point you need internet, but you don't need internet all the time in order to access this. So they're really going hard in this direction. And so it'll be interesting to see how that all plays out.
Yeah, and if they do that, perhaps that could almost dominate the market, right?
It could. Yep. It is a direct threat, I would say, to US dollar hegemony. Absolutely.
Got it. Okay. Now, we started talking about implications for the future, and you did say that Silicon Valley sees it, blockchain, as the digital infrastructure on which the next internet will be built. Will that happen? And will it be the new backbone of the economy? This is for you, Paul.
Yeah. So when people can do things, multiples faster than they could in the past, it leads to all sorts of new innovation and new ideas that we weren't even able to conceive of because we never had the ability or power to do that in the past. A lot of this technology will start to replace back ends of different industries and sectors just because it's faster, arguably safer, more secure, more transparent. A really good example I'll give here is Venmo, right? We're all familiar with Venmo. You push a button and you can, send money to a friend or pay somebody, right? And it seems from the user's perspective, very quick, right? I push a button, it goes to my friend, they have their money, and that's great. But when you start to peel the layers back to look at what's actually happening behind the scenes, it actually takes a few days for those dollars to finally settle wherever they land. And during that process, that transaction moves through about 5 or so different intermediaries, all which add costs, expenses, points of failure, more room for error. So the ability for this technology to replace that back end, and instead of 5 different intermediaries, it's a blockchain, right? Is pretty monumental. And then you can sort of take that idea and apply it to all different types of industries, all different types of sectors. So that's sort of a lot of the implications for the future of what this could do. Talking about the next internet, right? This whole idea of the Web 3.0. Right now, we have a system where you basically trust these massive tech companies, right? The Googles, Facebooks, Apples of the world, to hold on to your data. And they have your data and it's silent. Nobody else has access to that data except them. And then they decide what they do with it. If they want to sell it to somebody, they can sell it to whoever they want, or whatever their privacy policies, all those kind of things. But ultimately, every single company you interact with has this digital representation of you, in their server somewhere. What sort of blockchain unlocks and Web 3.0 is it really moves that power back to the individual, where instead of me being digitally represented and having no control over what happens to my data with these different companies, I actually own the private keys to my data, and then I decide who I want to share that data with and interact with. And I'll leave it at that unless you want to add anything,
Well,
Lewis.
I mean, as you
Right.
know, there are these huge debates now about privacy. And so what you're saying sounds like that this new system could much better protect people's privacy.
Absolutely.
Ah, I didn't know that.
Mhm.
Okay, now, Lewis, you're a lawyer. Are there any other legal issues we need to think about?
Well, there's a lot of legal issues you need to think about. And I think I didn't take a moment at the beginning, so I'll do it toward the end with my own disclaimer. But of course, this is not legal advice. I'm not your lawyer. And, if you have any legal questions, you should seek the advice of an experienced lawyer. So with that said, I mean, there are a wide range of legal and regulatory issues that apply around digital assets. Just from the most basic of, well, what is the appropriate characterization as a matter of law to a digital asset. What does it really mean? Our commercial law doesn't really have a category for this type of asset. In some respects, you can refer to digital assets as commodities, but the federal definition of commodities is a very broad one. It's basically anything that's capable of being traded on a futures market, which doesn't, tell you a great deal. What does it mean for purposes of commercial law for other lawyers out there that use Uniform Commercial Code? There are a lot of questions. The committee that drafts the Uniform Commercial Code has proposed a new Article 12 to the code that would attempt to set out a legal framework in the United States for this, but it's a long way from being adopted by the states. At another level, people who use digital assets, so that's what is a digital asset. You also have questions on the what is a digital asset for different characterizations. So for tax purposes, right, for federal income tax purposes, it's generally treated as property. A challenge around that is it's not given the special status of a currency where you can exchange it readily. A property, every time you exchange property for other property, you have to determine whether you've had a gain or loss. And that's one of the reasons, of course, that makes using a digital currency, Bitcoin or otherwise, for payments, a real pain in the neck, because you have to figure out what was your basis. You bought a cup of coffee, you spent 1/10 of a Bitcoin or whatever it might be, and it'll be a lot smaller slice than that. And these days, but you have to figure out what was your basis, what was your gain at that moment in time, especially because as we've recognized, the price is volatile. The time you bought the cup of coffee, 10 minutes later, the price could have gone up or down. That's not relevant. It's at that moment. So it gets very complicated. That's for tax purposes. I alluded to the SEC chair, Gary Gensler, giving remarks to the Senate Banking Committee earlier in the day. Chair Gensler is firmly of the view that the vast majority of digital assets are securities. This has enormous repercussions for Paul's business, for many businesses, for anyone really who wants to use these things. Securities are highly regulated types of assets. Only FINRA registered broker dealers can do certain types of activities if they're securities. So Paul, you alluded to baseball cards. If you wanted to start a market, you thought you had, holy cow, mom, all my cards and they're still in the basement and they're in great shape. I'm going to start a marketplace and I'm going to just put an online marketplace. People can buy and sell and trade baseball cards. You don't need to go get any approvals to do that. You just go to town and create a marketplace. If you wanted to do that with something that was a security, that would be an exchange. You would have to get an exemption, which is only available to a registered broker dealer, and then something called an alternative trading system or ATS. And it's very complicated, very costly, very time consuming. So it makes just all the difference in the world if digital assets are characterized as securities or not characterized as securities. So you have issues there. As we said, we also have issues for how you use digital currencies. Digital currencies readily lend themselves to the process of money transmission, which is moving, funds or value that substitute for funds from one place to another place. And people have used all kinds of things besides traditional currencies to engage in money transmission. Money transmission is not inherently a bad thing. You go to your Western Union and you send money to your deadbeat cousin, because they need the money. You could do that. That's legal, but you have to work through a licensed entity. And so when you do a peer-to-peer transaction, at what point do you trigger that? If you're only sending Bitcoin to your deadbeat cousin, that's probably fine. That's not an issue. However, if someone gives you the money and says, I don't know about this Bitcoin thing, man, could you do it for me? I'll give you a little money. All of a sudden now you're in this for business, you're making a profit from that, and you probably do need a license to engage that with any regularity. So a lot of subtle questions from the legal side around what the digital asset is, how it gets used, how various activities are regulated, all of which are just absolutely essential to having a functioning ecosystem around these assets.
Yeah.
Yeah,
Go ahead.
Yeah, I'd say I would just add a little history around, right when the internet was really birthed and started really coming to becoming mainstream, there were all sorts of crazy different lawsuits that different tech companies, back in the early or late 80s, early 90s, that kind of time period, because regulators just weren't really educated about it and they didn't understand it at the time. So it really is incumbent on our elected officials and regulators to educate themselves or seek education on this space. Back in, what was it, the 1940s or so, cryptography, really what makes all of this possible, was on the munitions list. So
Yep.
it was illegal for regular people to use cryptography in any way. And it wasn't until, people started figuring out, okay, if I want to send an email, right, it needs to be encrypted. Otherwise, my data is not safe. Oh, but wait a second, all of a sudden you're using something on the, the munitions list, which is illegal, to send a simple email. So as I imagine, I'm sure you'll predict too, Lewis, there'll be all sorts of crazy lawsuits that come in the next few years as sort of these regulatory frameworks and issues get worked out.
Yeah. Well, we're getting close to the last few questions. And one question that comes up, I mean, people like Janet Yellen are saying that it's very inefficient, it's slower than usual transactions and can't be trusted and this and that and all the regulation. Do you think that cryptocurrency has a future? I mean, do you think it'll go on for a long time, a real future, or will it be put under control? Or where do you see this going longer term? Both of you.
Yeah, I believe it definitely has a future. Long term, it's really hard to predict where we'll go in a few years. But I mean, assuming nothing too drastic happens and we kind of continue the course that we're on, I could firmly see a lot of this technology just really replacing a lot of the back ends of economy and finance that we use today. I think most people won't even be aware much of the time that they're interacting with these kind of things. Sort of like for us to be on this call right now, there's all these different internet protocols that are being utilized. I have no idea how they work, right? But they work, and we're able to communicate, from all around the world and host people from all over to have this conversation. I think the same will happen with a lot of these different blockchain technologies. I don't think there'll be one that really emerges to rule them all. It will be more of different blockchains specialize in different things in different areas of commerce, economy, and social life, all these different things to specialize.
Yeah. And Lewis, what do you think?
Yeah, no, I mean, I absolutely agree. To use a hoary sort of cliche, this genie is not going back in the bottle, but it's apt. This technology having been developed, the idea basically that value can be transferred effectively at a distance without an intermediary is not going anywhere. And I think the only issue is really that we haven't begun to understand what can be done with this. And the analogies to the early days of the internet are not the strongest, but in the same way that in the early days, for many of us, I suspect, remember when we first saw email or even just a basic web browser, to imagine, tools like Facebook, tools like Google Maps. I mean, I'm still astounded, to your point, Paul, that how I can get in my car and I just, within, nearly instantaneously, I can get directions to any place in the world, turn by turn. How on earth that all works? But we couldn't have imagined those kinds of tools and products and services in, pick your date, 1994, 5, 6, when we were first getting exposed to this. I think in the same way, it's very difficult for us to imagine today all the different ways in which these technologies, as Paul was saying, could be used to provide new products and services in the future. But it's certainly, I do not believe that it's going, oh, never mind, we don't have that anymore. I don't believe that, no.
Yeah, incredible. I mean, the point you made about perhaps blockchain can protect privacy more, and maybe also hacking. Hacking has become such a huge issue. Everybody gets hacked. So do you think that the blockchain technology could also help prevent hacking?
Well, it gets a little complicated. Hacking is indeed a challenge, as you say. A blockchain distributed ledger is extremely difficult to hack or to compromise. But digital assets can easily be hacked. They're simply files that are stored, and if you don't have careful cybersecurity of your own, your record, and in particular your private key, which allows you to control digital assets, can be stolen. It frequently is stolen. I think I would say, James, that blockchain and digital assets are part of an ongoing process of, kind of cat and mouse between illicit actors who do seek to compromise, the assets and information of others, and the wider community that believes that we should have greater privacy and protection. And I think that will continue. I don't think it's a panacea to solve privacy completely, but I think, or hacking, I should say more pointedly. But I think it's an important and necessary step.
Okay, terrific. Thank you. I think we can now move on to the Q&A. We only have 76 questions, so we have a few minutes to answer them. And I'm going to hand over to my colleague and friend, Bob Braddock.
Hi, this has been absolutely terrific. Can you hear me okay?
Yep.
Excellent. I've noticed that Lewis certainly, and perhaps Paul, you've been tracking the chat, so you probably have some questions that you would like to address. So I'll just kick things off, and then if there's some specifics you want to dive into, we can do that and continue on with the conversation. And I just wanted to pick up on, so let's say we're in crypto 1.0. So what does 2.0 look like? So we talked, so some very intriguing ideas that you put there. One, that it's the new internet. I mean, that's a kind of a mind-blowing concept. There's some questions about that. I mean, what does that really mean? What does that look like? And then there's some questions about how crypto is going to be used if we dial it out 3 to 5 years, for example. There's all of these different currencies. There's, Bitcoin, there's Ethereum, there's, what are the differences and characteristics? And I think, Paul, you kind of alluded to the fact that you think that you're going to have different types of crypto for different purposes. Can we just dig into that a little bit more?
Yeah, so different crypto, right? There's certain websites put the number, I think it's around 9,000-10,000 different cryptocurrencies floating around out there. Many of them have some very, very interesting use cases. Well, I'd say not many, maybe a handful of them have some very, very interesting and profound use cases. I'd say the vast majority of them, though, are vaporware or scams or just really not worth anybody's time. What really makes them different, though, are things like or how they approach what's called the crypto trilemma, where there's a trade-off between speed, distributed or decentralization, speed, decentralization, and security, right? So those are the three kind of problems when you come to building a blockchain, where if you want a super fast blockchain, typically it has to be much more centralized, because you can't handle, the network really can't handle that load based on current technology to make it efficient. So there's all these different trade-offs. So you look to something like Bitcoin, right? And arguably it's a slow network, but it is probably the most secure of any of the other cryptocurrencies out there, right? And also one of the most decentralized too, right? So you trade off on speed for more security and more decentralization. Different types of cryptocurrencies approach that in different ways. So something like Solana, for example, is more centralized, which allows them to have a much greater speed, because they can process a lot of the network's capacity on their own servers, or it costs a lot more to have a node or a hosting thing to make that blockchain run. Right, so there's all different kinds of trade-offs. So that's one way that cryptos are different. Another is something called tokenomics, and that's just a fun play on like the economics of the actual blockchain itself. Right, so it's looking at things: what is the supply? How many, how distributed is the supply? Is it all concentrated with a handful of people, or is it widely distributed to a bunch of different people? And then what is its issuance rate or inflation rate that is built in at the protocol level? So you have something like Bitcoin, which has a finite supply, right, where the supply caps out after a certain amount of time, and then there will be no more Bitcoins ever created after that, right? So you have essentially codified monetary policy, right? Or this is what essentially tokenomics is, right? And so different coins, different cryptos all have different types of inflation rates and supply caps and distribution sets too. So
Well, that's a lot
I'd
of
say that's
homework.
really what's up. And then some are more focused on, well, no, I'll just leave it at that. Yeah.
That's a mouthful. A lot of homework there to understand. Lewis, anything to add to that? Just as you look out in the next few years, and we'll move on then.
No, those are great remarks. The one thing I'd highlight for people, because I think this does sometimes cause some consternation, is some digital assets lend themselves to being what we loosely refer to as cryptocurrencies. That is a substitute currency, a means of payment, and potentially a store of value. But many other cryptocurrencies aren't really, their purpose is not so much, to make payments. The purpose is to facilitate the formation of a decentralized network. And that's really, a different sort of thing. Particularly, we talked about, other smart contract platforms like Ethereum, you've heard of, Solana, we mentioned, et cetera. The digital asset can be used for payment, but its real purpose is to create a viable ecosystem in which, a disparate group of people contribute their resources. In the case of those platforms, the resources are computers that can do computing. And they contribute them voluntarily in exchange for rewards. And so the purpose of the native token is not so much to make payments, it's to incentivize people to contribute resources and get benefits in a decentralized way. And that's proven to be very successful. I think it's important when you think about cryptocurrencies to think about those economic models. I think that's, in my pinned tweet in my Twitter feed, I say, we don't need 1,000 different digital currencies. We do need 1,000 different economic models or decentralized economic systems. And that's what we're just beginning to scrape the surface on today.
Well, there's a question about what you can buy with Bitcoin, and a house, a Tesla. So what, as a practical consumer, as opposed to an investment, which we're not going to get into here. I mean, there's been some questions about, should I invest in crypto and those kinds of things. That's not the purpose of this session, so we're not going to go there. But in terms of use of crypto, how practical is it to buy stuff these days, and what do you think it'll look like in 3 to 5 years?
Yeah, so using something like Bitcoin today to buy a cup of coffee is really not practical. The transaction fees are too high. It really just doesn't make sense yet. There are working on, scaling layer 2 solutions, other things that essentially are built on top of the layer 1 of Bitcoin so that it can make things go faster. Same's happening with Ethereum and several other different blockchains. So for certain things, right, like the low hanging for like cross-border payments or remittance, international remittances and things like that, it's really easy for me to send funds to someone on the other side of the world. Few clicks of a button settles with the transaction settles within a minute, and my family back home, wherever that may be, has those funds. And so for those types of transactions, it's great. I think like Tesla accepting Bitcoin for their new models is I don't know, what would you say that is, Lewis? It's more like a for show,
gimmick.
I want to say.
Yeah, gimmick. It's a gimmick.
It's gimmicky, right? Mm-hmm.
I think one of the problems, just to pick up on that, with using Bitcoin in particular as a payment tool, is that most of the people who are Bitcoin proponents believe that it will be much more valuable in the future than it is today. And so when you talk to them, they say, well, why would I ever give away my valuable Bitcoin, my valuable Satoshis, which is the smallest unit of Bitcoin? Why would I ever pay you with sats when I can just pay you with these crappy dollars that are going to become worthless soon? So actually the people who are the biggest proponents often are the last ones to want to actually use them for spending, and instead want to just aggregate them and accumulate them because they believe there's a world that with dollars and other fiat currencies will be worthless, and they'll be sitting on a big pile of smog like gold.
I see. So right now you would say that crypto is basically a speculative investment of some sort, and well, maybe you could choose different words, but I think there's a question here: is why is it so volatile?
Yeah. So it's an unregulated market. There's no protections, right? So typically in the stock market or something, if markets move too quickly, too fast, they have stop gaps that basically halt trading and freeze things. Because these are unregulated markets, there's no entity that is initiating those kind of stop gaps. And then on top of that, there is a lot of leverage in this market. So it can get very, very over leveraged very quickly, so that when there is a small move downward, it can cascade into a liquidation type event. And you see these 20% plus moves that happen in a short period of time. Honestly, I would say it's a function of free markets.
And people can borrow against crypto these days too, right? And that's part of what you're saying, that it's like a, bringing up margin in the traditional way. I see. Yeah. So that affects it. There's a question here, and then I'll see if there are any particular questions in that chat that you would like to address, but one that I don't understand, maybe you do. Explain the concept of hash, H-A-S-H.
Going to take a go at that? You
Yeah,
want
go ahead.
Yeah, so this is actually a relatively, once you kind of understand it, it's quite simple. So it's a mathematical process or algorithm in which you take a large set of data, numbers, effectively ones and zeros, and you condense it down to a much smaller set that is uniquely related to the very large set. So there, maybe while I'm talking, you can even find one of the little sites online because they're fun to play with, if you know what I mean. So you could give any set of data to an algorithm, and Bitcoin uses a particular hashing algorithm known as Secure Hashing Algorithm 256 or SHA-256. It's one of many, many, many hashing algorithms. And you feed a set of data into that algorithm. The algorithm will process it and come out with a finite string, alphanumeric string, which is, I think in the case of SHA-256, is it, how many, 64? I think it's 64 hexadecimal. I don't know. It's a string, it's about, it's some length of that. But those strings, right, are sometimes referred to as a digital fingerprint. So it is functionally impossible to go from the hexadecimal string, or just, 1 through 0 and A through G or whatever it is. It's virtually impossible to go from that hexadecimal string of 64 characters back to the original data set. But anyone who has access to the original data set can regenerate the hash or the fingerprint with absolute certainty. So this is a way, it's like a checksum in Excel. You will know with 100% certainty, if you're looking at the same data set and you have the hash, if you apply the hashing algorithm to the data set, and you get the same result, it is the identical data set. And again, if you make one tiny change in the data set, so you take the entire, Torah and you hash it, and then you change a period in one place, you change a letter, you will get a completely different hash output. And so the hash is just a unique digital fingerprint that what it is, and that gets used, in the Bitcoin algorithm. The hash is just a way of taking a large data set and producing a uniform, very small data set with a unique relationship to the large data set. Hopefully.
Excellent. Do either of you, or Jim for that matter, as you're looking through the chat, have any? I have a couple other questions I can pose, and we have several minutes left. But is there anything particular that you wanted to respond to, either Paul or Lewis?
I just wanted to add, I saw a few questions to go back. I think we were talking about security and like getting hacked and things like that, where you look at something like the actual Bitcoin blockchain itself has never been hacked, right? But it's the third-party intermediaries who people interact with who end up getting hacked. So you hear about, oh, this crypto exchange was hacked. Well, that's because a bunch of people, went to this centralized entity, put their funds on it so they could start buying and selling these different cryptocurrencies, and that exchange had poor operational security and got hacked, or there was an inside job or whatever else. It's not the actual blockchain that got hacked in that case. So I just wanted to clarify that point.
Thank you.
Maybe one last question. People talk about the different currencies in different ways, like Ethereum now is better than Bitcoin, or this or that or something else. Where do these reputations come from? I mean, why do people say these things? What makes them think that one is better than the other?
Yeah,
Well, the
so,
Mets are, I was going to just say the Mets are better than the Red Sox.
yeah, no. Pick your team. Right, there's all sorts of different online communities that, so one thing people really talk about is tribalism in the crypto space. And it's both a feature and a bug at the same time. Because on the one hand, if you have an active community that is extremely vocal, it brings a lot of attention to that community, which helps it grow, right? The flip side to that is that community could then put its own blinders on and say everything else is junk. This is the only one that's good. So you have a lot of that going on, and a lot of that is just enabled where many of the participants are just digitally native, younger people who this is what they know, get in front of a computer and smashing the keyboard to start arguments or trolling other people. It's sort of part of the culture in a way too.
Okay. Well, I think we've come pretty close to the end. And unless there are any final comments, questions, I think we've had.
I have one more. Let me throw this one out just because it's jumping off the page to me in the chat, and I got to pay attention. What is a stable benchmark? What does that term mean in terms of pegging to a crypto, and what are some examples?
Yeah, so there's all these different, I guess, stable coins out there that are, there's two ways to approach it. There's something by, I think it's the Maker DAO, that they have a token called DAI, which is an algorithmically balanced, distributed stable coin where anybody can mint new dollars by putting up collateral of their own to mint those new dollars, and that stays algorithmically balanced. Not to get too far into the weeds there. The other ones are, like we mentioned earlier, are more these like things like USDC is an example. That's a stable coin that is backed 1-to-1 with US dollars, or so they say. You have things like Tether, which sort of is a black box that I don't want to get too into, but these are theoretically backed by dollars or commercial paper somewhere else that is ideally audited. So you have these stable tokens that represent, say, 1-to-1, or do their best to represent 1-to-1 to the US dollar, or whatever their benchmark is, or whatever their peg is. So you could have a like a crypto euro, or a stable coin euro, or any other currency you could really think of. Yeah. There's even representations on. We didn't get into the whole idea of tokenization, but you have even things like gold, where physical gold held in a vault. You could have a digital token that represents that share that you can then trade with whoever you'd like on these different networks. But that share actually represents ownership of that gold that is held somewhere. Right. So all different ways to peg these things.
Yeah. Well, since you're talking about this, I've been reading about these things that I don't understand. BlockFi as a lender, Kraken Bank, and then there's BitClout. And you talked about stablecoin. What are all these things?
Yeah, a bunch of different things there. So BitClout is like a social media platform that is based on a blockchain. Simple as that. BlockFi are sort of like these. It's basically a fintech company that uses crypto sort of on its back end and provides lending services, but you still go through a centralized entity. It's like, yeah, that's like the BlockFi. Things like Kraken, Coinbase, Gemini, those are basically fiat on-ramps, or places you can go spend, connect your bank account or whatever and spend your dollars to then buy these digital assets. And those are sort of like, there are other ways to do that too, but those are sort of like the main digital exchanges in the United States anyways.
Any comments, Lewis?
Yeah, I just want to amplify. I mean, you hit on, James, a great point, and just looking at the, some of the commentary, it's easy to get lost here. There's all kinds of terms. Sometimes is it a technology? Is it a company? Is it just somebody saying something silly on the internet? It's often all the above, right? I would say, if we have, tweaked the curiosity of some of the many folks who've been kind enough to dial in and listen, I would say pick some people, particularly on Twitter. Twitter has unequivocally the best discussions of this. There's a lot of sorting out of wheat and chaff, but follow. It's not difficult to find, the main voices talking about this, and just start. It's like diving into a moving river, right? You're not gonna, the first time you get in, it's gonna be very confusing. There's gonna be a lot of noise, but you'll start to pick up BlockFi. Oh, you're seeing that often enough. You're seeing these different terms. Some things pop up more than others. Some things seem more relevant than others, and just let yourself kind of get carried down the river a bit. And soon enough, you'll start recognizing patterns. You'll start seeing stuff that doesn't make a lot of sense, some stuff that does, and commentary. And it's really this just open agora where a lot of folks express views, and it's very exciting. Sometimes it's super frustrating, as we said, and I think the word tribal Paul used is perfect. It becomes very tribal. You'll see, people just sort of jump on something and be very positive or be very negative, and there may not be any apparent reason why. Someone in the comments asked about pumps and dumps and protecting themselves. That is absolutely a phenomenon, and you do have to be thoughtful, about that. But the only way to engage is to kind of dive in, start swimming, observe, and then fool around a little. Nobody would recommend, we don't recommend any investment, but I would recommend, if you're intrigued, open a Coinbase account or a Gemini account or a Kraken account and just buy a little bit and then find out what you do. Maybe take some of it off in exchange, in a very modest amount that, if you lost it, it would be irrelevant to you, and fool around, and then get a MetaMask wallet, which allows you to do a lot of things yourself, and just see what happens. And, being mindful, and Paul, I think you alluded to a very, very important point on transaction costs. There are things that can be very costly and that are functionally prohibitive at small amounts, unless you're relatively wealthy, in which case, whatever, good luck to you. Yeah. But fooling around with this is the best sort of thing. And I would encourage, you and all your terrific, listeners to just engage and learn. And maybe it's not for you at all, and that's fine. Then move about your business. But maybe you do become intrigued, and becomes really exciting in your life.
Yeah, I get it.
To add, I would just say, extremely well said. Just watch out for maximalism on especially on crypto Twitter, and keep an open mind.
Yeah. They've also been talking about a digital casino. Is there any value to that? Is it going to happen?
And there's numerous places already you can go and gamble your crypto online. Yeah, all over the place.
All right.
And those are really like the low hanging fruit for these kind of technologies, right? Like that's typically where, strangely enough, a lot of innovation starts, and then from there it spreads to the much broader economy. So.
Right. Okay, Bob, is there anybody raising his or her hand? Is there anything else that's pending here?
No, I don't think so. I mean, there's been a couple of questions about, should I invest or in crypto, or, is it a good investment? And I just repeat for everyone that the purpose of this session is educational, not to give any indication one way or another about kind of the appropriateness or lack thereof. From an investment perspective, what we've attempted to do is provide a baseline of information, and those kinds of questions you can turn to your personal advisors for. Yeah. And I'm not an expert at disclaimers, but that's my best attempt. And we're an educational institution, and not going to get into that aspect. So back over to you, Jim.
Well, I really would like to thank you very much, Paul and Lewis. This was really helpful. It clarified so many things. I see Shelley Cohen raised hand.
Well, we don't have the ability, Shelley.
Okay.
I think we probably are a good moment to wrap up.
Yeah.
I would just, if I could just add, our website, willowcrypto.com/resources, has a bunch of videos that Alexandra Dessa and myself have put together that really go into a lot of these topics too, in a little more detail, or just gets a little more granular, and is a little more condensed on some of these things. So, you know, if you're
Okay.
looking for more information too, I'd just like to say that that's out there.
Very good. Very good. Well, look, I'd like to thank you so much. This is such an interesting and exciting topic. I mean, there's so much potential, so many things going on, and it's good for all of us to understand better what it's all about. So I'd like to congratulate you and thank you. And perhaps we will continue this conversation down the road. And once again, we're very grateful for your presence and all your comments. So I think we've reached the end and look forward to continuing later. Thank you very much.
Thank you,
Thank you all.
James and team.
Thank
Thank
you.
you, everyone. Thank you, Paul.
Yeah.
Bye-bye.
This is wonderful. Thank you all.
Bye-bye.